Well, good afternoon, and we have some nice springish weather today. I think we're being teased. It's probably going to do its abrupt change to 85 and 90 in a few days, so we need to enjoy it while we can. But you know, the topic today may not be something that's as lively and invigorating as being outside on a spring day, but it is very important. The economy with the COVID-19 pandemic has not been very kind to people in a, you know,
on the payroll thing.
Gotcha. Here we go, Wizards. Dustin, I can help you.
is someone, I think someone's talking.
Let's see.
There we go. All right.
Oh,
All right, I'll try again. It
yeah, there we go,
like
guys.
somebody, it sounded like someone was taking an order or answering the phone
Yeah.
or something. Yeah. Well,
All right.
the last few weeks have been kind of hectic, and business is still uncertain with the economy the way it is. A lot of people are unemployed. Business is kind of stagnant and slow, and hopefully we're at the end of the beginning, as Winston Churchill once put it. And so hopefully we're starting that upward swing, but doing it very slowly. But many of us have, many people have gone out and gone through the first part of this PPP project, which is the payroll protection program. And you have gone through the gauntlet, I guess you would say, of all the work and the rush in trying to get a loan for our organization, whether it's a business or a nonprofit. And that in and of itself was quite a challenge. And so we're going to go over some of the things that we need to be thinking about going forward, because the ultimate goal for all organizations with these loans is to try to have the loans forgiven at the end, use the funds to maintain payroll, keep the business open. So when the economy starts its upward swing, then we're all here to enjoy the upward ride. So to start with, I thought I would go over what is the PPP loan. I'm not going to spend a lot of time on this because for everyone, most people on the call, they've already gone through that process. If not, please, I encourage you to go speak with your lender. I think there still are funds available for this. But the base amount of the loan is calculated, and this is just at a high level, but it's calculated based on the historical payroll and some other overhead costs. Congress was trying to come up with some common sets of costs that businesses have to have at a base amount to operate and keep people employed. And the funds, this is it is a loan, but the funds received from the loan have to be used for eligible expenses, and we will go over those in a minute. And as of right now, the time period is 8 weeks. It's an evaluation period, or also called a covered period. For the forgiveness. So once the loan funds are received and then spent during this 8-week period, then we can determine how much is going to be forgiven and what happens if that doesn't happen. So to begin with, the PPP loan funds received, we've got them. Now what do we do? Well, we have 8 weeks to do something with them in accordance with the loan criteria and the forgiveness criteria. And the 8 weeks, as of right now, begins on the date that the loan was funded, which means the date the cash was deposited in our bank account. It doesn't mean the day the application or the note was signed. It means the date the actual funds were received. And I will use this phrase, as of right now, several times during this presentation, because just the application process alone, about every 2 days, more commentary and rules were changing as the process evolved. Now we're in this spend and forgiveness phase, this evaluation period, and there's been a pause out of Washington right now on any new commentary, but there have been a lot of questions as we go through. You'll see what these are that have been posed to the SBA and the Treasury, and so we will probably see more guidance. And so some of these things could change. And one of the things that's pending or not pending, but is proposed, is to change the 8-week period, because a lot of companies, when the economy started slowing down, they went down in employees, and now they can really use the funds. It may be 2 months down the road. They may be exiting the 8-week period when they can really use these funds to keep the company going and employ people. So, but as of right now, it is 8 weeks from the date the loan is funded that the evaluation period begins. And so what can the loan funds be used for? We will go over these in more detail, but payroll cost, interest, rent, and utilities. And you see interest and rent on there. You know, most organizations, they have capital assets, and they're either owning them and they have a loan on them or mortgage on them, whether it's personal property or building, and then rent for, you know, copier and things like that. So there are costs associated with owning capital assets and keeping the lights on. And so I think Congress probably intended this to be some of the basket of some of the basic expenses that most all organizations with employees are going to carry. So this is, hopefully this will help cover that during a short duration until we're on the upswing. So payroll costs, we get a lot of questions about payroll cost. If we, you know, ask 10 different people, we're going to get 10 different answers because, you know, people are paid in so many different ways. There's so many different compensation packages today. It doesn't have to be a high income person to be receiving a complex package. It's just a lot of different buckets. So the first item that is included in payroll costs are salary, wage, commission, and other similar compensation. And this would be very similar to a W-2 amount with a couple of exceptions, but this is basically the gross pay. So if someone is paid $100 for the week and then has, you know, their payroll tax withholdings, their Social Security withholdings, and all these things out of there, this is the gross pay. This would be the $100. So this is the starting point. It also includes cash tips or the equivalent, vacation, parental, family, medical, or sick leave. If this is broken down separately on the paycheck, this is covered as well. With the only caveat, you see family and medical and sick leave up here. There are more stimulus and economic assistance programs other than this PPP loan coming out that, you know, that people can use. And one of them is a tax credit that is granted for providing family, medical, and sick leave under certain circumstances. And so if tax credits are received under there, then the payroll may not be included in the forgiveness calculation in the PPP loan. So the bottom line is, if we have a PPP loan and we're going to use one or more other government programs or stimulus programs, then probably need to look at some of the fine print and see if it prohibits overlapping or duplication. Some do not, but some do. So that would be a good thing to look at. Allowance for dismissal or separation. Actually, you know, could be if headcount does need to be decreased and there are some severance packages in there, that qualifies. I actually got a question today, as a matter of fact, that covered some of this, and so it does apply. Group health care coverage and insurance premiums. These are non-cash to the employee, but they are included in as well. They are a cost of carrying that payroll. Retirement contributions and payment of state and local taxes that are assessed on compensation. And we, in Georgia, probably the only one that we have like this is state unemployment SUTA, which is not a big number. And a lot of this may have already been paid, since it's paid on the first few $1,000s. It may have already been paid and hit the cap already, but if not, it is included, and dollars are dollars. So the one thing we have to remember, though, is for the first 4 items above, the cash compensation items for employees, on an annualized basis, that can exceed $100,000. So for those 4 items, basically during that 8 weeks, 8/52 of that couldn't be more than what it would be for that same calculation for 100. So there is a cap on that, but it doesn't apply to the items in gray. Those are non-cash benefits that are provided by the employer, and those would be included in addition to a salary and are not limited by a cap. The one item you will note that is missing in there is the employer's Social Security and Medicare, because everyone knows the employee withholds 7.65 out of their paycheck, and the employer matches 7.65. That employer match is not included in this payroll cost. And it's kind of odd because that is a large dollar amount of carrying payroll. But the only thing we can surmise is that Congress has other programs that either defer payroll taxes or tax credits and things like that. And so they may have thought we've already covered that with another program, but they really didn't. So that is omitted, and we get a lot of questions on that. The other item that's not included in here as well that we get a lot of questions on is payment to 1099 independent contractors. Payments to 1099 contractors are not included in the company's payroll cost for forgiveness purposes, because the independent contractor can apply for their own loan and their own forgiveness. So those dollars are kind of used there. So interest. Interest over this 8-week period is included if it is on a mortgage of real or personal property that was in the loan was incurred before February 15th, 2020. And you may not think much about personal property, but if a company has a fleet of vehicles, and as of right now, unless there's further clarification from the SBA, then that would be included as well, as long as the loan is secured by that property. Rent follows the same premise. Rent under a lease agreement that's in force prior to February 15th, 2020 applies to real, and we can't see a reason why it doesn't apply to personal property as well. So if you're leasing vehicles, leasing a copier, leasing a forklift, we can't see where that is not allowed yet either. So that, unless something comes out to the contrary, then we think that would be there as well. Now, one question that comes up a good bit when we are looking at rent and some of these expenses is, well, can I prepay my expenses for 8 weeks? Or 8 months? Can I, do all sorts of things to try and cram as many expenses as I can in this 8 weeks? And of course, we encourage everybody to pay as much as they can during the 8 weeks. We can't see anything that prevents it. However, there is a little caveat in the law that basically says that the forgiveness amount means the principal that a lender reasonably expects a borrower to expend during this evaluation period. So if your borrower would reasonably expect you to prepay your rent, for 10 or 12 months, then that might apply, but I would doubt it. So they're looking to try and cover all the monthly type expenses in these categories twice over an 8-week period. Utilities for services that began before February 15th, 2020, and the beginning before February on this one is probably not a hard one to do, but these are the pretty standard expenses that you would think of: electricity, gas, and water. And here's one anomaly: transportation. We usually do not think of transportation as utilities, and there really is no definition of what transportation is in the law, or how they're including that in here. The only thing that we can find is in one of the SBA's rulings that they issued, they were discussing sole proprietors that were Schedule Cs, and in that ruling, they defined transportation as basically the gas, the fuel for vehicles for a business. So if this is a large amount, you may want to consider this for your company as well. So if someone has a fleet of vehicles, this could be a large number, and the interest or the rent on those vehicles could be a large number as well. So not something we would normally think of with utilities, but it is in there. Telephone and internet access, a lot of those go hand in hand, but those have gotten where they're large expenses as well. So just as a recap, the types of expenses that can be included in the 8 weeks after the loan for forgiveness are payroll costs, which are, I lost all my payroll costs, I apologize. Payroll costs, interest, rent, and utilities, and all of these are the type of expenses that would be expected to ordinarily be paid within an 8-week period after the loan is funded. And so now we've looked at the planning that's needed. And that's one thing a lot of people forgot. I think some people at the SBA thought, well, the forgiveness, we don't have to deal with that. A company doesn't have to deal with that until the end. Well, you really have to plan how you're spending all of this money so that you can maximize the forgiveness. And so here we have the criteria of, what we need to try and spend this money on or keep up with it. So the next question is, how do we track it? Because at the end of the forgiveness period, each borrower will make an application for forgiveness with their lender unless the SBA changes how that approach is going to go. We don't know what the forgiveness application will look like. We don't know what that process will look like. But if it's anything like the applications for the loan, every bank is different just because they have different criteria. So we have seen a lot of different spreadsheets, summary documents, tables of examples given out to borrowers so that they can track this by the week. And so there are a lot of those out there. And one of the big items that's been mentioned is a separate bank account. In theory, this sounds pretty practical, because if I'm borrowing $50,000 and I'm going to use it for those criteria and I need to prove that I used it on those things at the end of this loan, then why not just dump it into a bank account, write checks, pay all the bills? I've got a clean record keeping right there. I can prove that I did it. That in theory, that sounds very easy and may be used in some concept, but today in electronic banking with payroll drafts, tax drafts, online bill paying services and all of those kinds of things, the operating account, it's very difficult to take different types of transactions, go from a Tuesday to a Monday 8 weeks out and start running those through a different account. If that is practical and works for your organization, I would encourage you to do it. That way it doesn't, it shows that there's no commingling of funds. If I had started construction of a building and I've got cash being outlaid for that and I can't stop it or I'll be detrimentally affected, then if I have a separate bank account, there's an easy way to show that I'm not commingling. The other, as we mentioned, is like a spreadsheet that can be used. A lot of people will look at a spreadsheet or a record that was provided from the lender and say, well, gosh, I could do this a lot easier in another manner. Well, the bank may have hundreds or thousands of these loan forgiveness requests to review. So if they need it in a certain format, please give it to them in that format. Your records, your underlying records that you're going to provide as well may be different, but the summary document, whether it's a spreadsheet or some other format, they're probably going to need it in that format so that they can review it very quickly. And that's what you want. The good news is most accounting packages and ERP systems today, even the inexpensive ones, are able to really keep track of the books and records so that you need them. Now's the time, though, if we have one expense account for insurance, well, let's break one out for employer paid health insurance so that at the end of the 8 weeks, we got a bucket there, an account there that's easy to find. The same for the interest, the same for the rent that qualifies. Try to go ahead and have everything broken out so that the system is keeping track of it so that it can easily be retrieved and pull supporting documentation, because the law does say that the borrower will make an application with the lender for forgiveness and will provide payroll tax reports such as 941s, and then canceled checks, possibly invoices, any proof of payment. So it's the easier that those documents can be retrieved and tracked, the better over this 8 week period. So, all right, so now we know the types of expenses that we can, that qualify for the forgiveness, which is what we want. We've got a system in place to track them. Well, how is the forgiveness actually calculated? And this is about a 5-step process. Parts of it can be complex, but it's not meant to be overly complex. So the first part is to calculate the bucket of expenses. And at least 75% of the loan funds should be used for payroll cost. And the payroll cost, again, are all of these items. And that's what they're wanting. They put that 75-25. That wasn't in the law. That came about later. But the SBA and Treasury started hearing about companies that were going to get this money and then not actually pay the employees with it, but use it as a loan. And so they really wanted this. The purpose of it is to protect payroll, like the PPP says. So 75% needs to be on these types of costs. Uh, and this is providing a little bit of confusion now, because when they first implemented the 75-25 rule, basically they said that no more than 25% of the forgiveness amount can be from non-payroll costs. So when you read that, you would think, well, if I spent 70% on payroll costs, then yeah, I'm going to be able to get 70% forgiven. The other 5 just will not be forgiven. And then 25% of my non-payroll costs will be forgiven. So basically 95% will be forgiven. And of course, our loan was, the amount we calculated for our loan was really an estimate anyway. We were using that as an estimate. But subsequently, a couple of weeks later, they were issuing some additional guidance about something else, and they made the affirmative statement that at least 75% of the loan funds should be used on payroll costs. And so some people are reading this like it's a cliff. Well, if I spent 74% of the loan funds on payroll costs, then I don't get anything forgiven. I'm not eligible for forgiveness part of this program. And so I don't think that's going to be the case, but we have to be cautious. I think hopefully SBA will come out with a formula that will actually calculate how much of the payroll cost will be forgiven. I apologize. My phone was ringing here in the office. I didn't turn it on Do Not Disturb. So if less than 75% is used for payroll costs, the forgiveness amount is reduced. We just don't know what that formula is right now. I would hope it would be that if you spent 70, then you're just 5% of it is not, but we will have to wait on the SBA to provide a little guidance. And we haven't heard much out of them, like I said, in the last week. So hopefully they're putting some really good documentation together to guide us through the remainder of this forgiveness period. The second step, once we've calculated our basket, whether it's limited or not, say if we borrowed $100,000 and the forgiveness based on that first calculation, we're limited to $95,000 that can be forgiven. We have another sifter to pour this through. And this is the description here, maybe a little bit misleading, but did headcount decrease? And, for example, if I started out with 20 employees and then I had 15 during this period, then I have 25% less employees, then my forgiveness amount may have to be reduced further because I didn't maintain my headcount. And it's actually not headcount, it's full-time equivalents. And the full-time equivalents are compared to the lesser of a period back in February 15-19 through June 30-19, or the previous January and February in 2020. The average monthly full-time equivalents in either one of those periods, the lowest one, compare that to what my full-time equivalents were on an average monthly basis during the 8-week period, and see if my full-time equivalents decreased. And, everybody's asking, well, what is a full-time equivalent? We're waiting on the SBA to define that. But what they might do is borrow the definition from the Affordable Care Act. I think its definition is if someone works 30 hours or more, they're considered full-time. For the rest of the workforce that work less than 30 hours, then take all of their hours, throw them in a bucket for the month and divide it by 120. And that's the average full-time. That's the full-time equivalents plus your other people that work more than 30. You put those together. So you can see there is going to be quite a bit of math here to make sure that this is, that the forgiveness part of this loan is not reduced even further. But if everybody maintains their employees, then this shouldn't be a big deal. The third step, and I haven't spoken to anyone that thinks they're going to encounter this, but if employees' pay is reduced by more than 25% during this 8 weeks period, say if someone makes $100 a week and their pay is going to be reduced to $70 a week, their pay was reduced more than 25%, then the excess above that 25 is not eligible for forgiveness. Like I said, I have not seen or heard from any companies that this might be an issue. I know there's some companies that may have to do a little pay reduction, but they're trying to do that on some of the owners in the upper end first. And so you can see this really doesn't apply. The penalty part of this calculation for forgiveness doesn't apply to employees with annualized pay of less than, or excuse me, annualized pay above $100,000. So if someone's making $200,000 and their pay drops to 100, then the company is not going to be penalized in the forgiveness calculation for that. But that is just something to keep in your mind. Now, thinking back about steps 2 and 3, one is a reduction in workforce and the other is a reduction in pay. And some of those, the company may have already done that before they even started on the loan. So there is a little hope here. There is a rehire provision. So for companies that had a reduction in pay, or they had a reduction in full-time equivalents that occurred between February 15th and April 26th, that is 30 days, the 30-day anniversary after the law was enacted, then as long as those full-time equivalents and the pay is restored by June 30, then the borrower can deem those two reductions as if they did not occur during the 8 weeks. So if headcount or excuse me, if full-time equivalents drops between February and April 26th, but the company restores that by June 30, then that penalty calculation is not going to be as harsh. So that is one thing to keep in mind. The only caveat, we heard a lot about companies that says, well, I can just lay people off and then hire them back on June 30 and I'll be okay. Well, if we haven't spent the money on payroll, then the forgiveness basket in step 1 is going to be reduced before we even get here. So the goal is to try and keep everybody employed. And this is one reason that there's been a strong lobby to extend that 8-week evaluation period a little bit longer, because some companies, depending on where they are in the sales and services supply chain, they could be 3 tiers down, 3 tiers up. They may not be prepared to bring their employees back until July, and that way they're outside of this window. So they're trying to see if they can trying to get Congress to change this so they can line that up more with when people will need them, because everybody's not going to be in the same 8 weeks, and everybody rushed out to get the loans at the same time. The fifth and the last thing to consider in the forgiveness is the EIDL, which is the Emergency Injury Disaster Loan, if I'm pronouncing that correctly. Like I said, there's a plethora of stimulus loan programs and things to take advantage of, but this particular one had a $10,000 cash advance that did not have to be repaid. I think it was $1,000 per employee with a $10,000 cap. So if someone has an EIDL loan and a PPP loan, when it comes time for forgiveness, once they calculate the amount to be forgiven, then the EIDL cash advance gets subtracted off of that, because that was already free money anyway. And I guess Congress is trying to make sure that someone doesn't take one and double dip in the other. So I haven't heard of anybody doing that yet, but or actually getting the EIDL loan, but we have people that are considering it after they have the PPP loan. All right, just as a recap, to calculate the forgiveness amount, we have 5 things to consider. First, look at the bucket of expenses. Look at the 75-25 split just to make sure that we're in line with that. Did our headcount or full-time equivalents decrease? Did anyone's pay decrease by more than 25%? If so, were we able to restore step 2 and 3 by June 30? If so, we can treat that as never happened. And then, did we have an EIDL cash advance that we need to back out of here? And so we will probably be getting a lot more guidance and a lot more information from the SBA. But what this does, this is at a very high level, and it gives us the information to plan with, because if we know theoretically where we're having to steer a ship to for forgiveness with these buckets and headcount and timing and which loan to apply, other loan to apply for and which one's not, at least we can do that, because once the 8 weeks is up and we've made some decisions, we're stuck with the decisions we've made. So hopefully this gives you a little flavor for as of today, what to start planning for your 8-week period. And so now, we get to the end of the 8-week period, and we're going to calculate our forgiveness. And there's probably going to be a little mismatch between the loan amount and what's forgiven, because the loan was actually based on 2019 numbers, and it was 2.5 months, whereas the forgiveness period is spending it only on 8 weeks, and with a 75-25 caveat and all these other things on there. So there could be a little mismatch, and could be some of the loan that is actually not forgiven. And that's not all bad, because what remains, it is still a loan. It is a loan that is payable over 24 months at 1%. So 1% is still a very good rate. I think the first 6 months, beginning from the date the loan is funded, the first 6 months from that day, the payments are actually deferred. So the amortizing payments, I think, would start on month 7 through 24 at 1%. And the restrictions will, as of right now, will still apply for what the funds can be used for. So even if all of the money could not be spent, I'm one of those businesses that just couldn't get everybody employed until after the 8 weeks, but I still want to keep this loan to help cushion the pay, then the remaining funds for the loan still need to be spent for the payroll, the interest, the rent, and the utilities, which shouldn't be hard to do for most businesses. So now we come to 2 items that are very important, that were not contemplated at the beginning, but were brought up by Treasury and SBA, probably at the end of the loan process. And so these are something that we really have to be prepared for. As of right now, the funds that are expended that are forgiven. So if I have $100,000 loan and I spend $100,000 and I get all of that forgiven, those expenditures are not deductible on my tax return. And of course, the law specifically says that the loan is not included in our income tax, which is great. However, there is a provision in the tax law that basically says that any funds spent on tax-exempt income, those funds, the deductions are not allowed on the income tax return. And so what this does is, use my $100,000 example again, is I borrow $100,000, I don't include it in income, and I spend it and I deduct everything, and I get to the end of the year and my taxable income is $20,000 because it was a tough year. And so that's pretty good. I can pay the tax on 20. Well, now these expenses are not allowed as a deduction. So if I spend 100, then my taxable income is not 20, it's 120. And so I've got to pay tax on $120,000. So that's something that really has to be planned around to make sure cash is available. I don't think this is what Congress intended. Probably numerous commentators agree with that as well. And the IRS basically had to issue their notice, because that's what the other part of the law said, basically letting Congress know that, oh, by the way, you need to fix this other part, or this is going to create a taxable situation. So the CARES Act that created this is the 3rd bill in a sequence of economic disaster assistance bills. The one before that, I think, was the Family First Act, but they're working on one right now, and they're trying to get this corrected. From what I hear, Congress is fully aware. Whether they're getting this into the drafting, I don't know, but then there's supposedly a 5th bill of economic assistance. It could be for healthcare and other reasons, and testing for the coronavirus, but they're trying to get this in there. So this is something we're going to have to watch. But right now, we need to plan around this potentially creating a taxable situation. And so an example might be that if I've got employees that I only need them 5 or 6 hours a day, but I'm going to borrow this money and pay them the entire time. Well, if they're not productive, it's one thing to pay tax on money to get productive employees. That's, it's paying 20 to 30 cents to get a dollar. That's not bad. But if you're spending it to get the payroll in the employee's pocket, and then you have to pay tax on top of that just so the employee can have money, then there are probably other avenues like unemployment that might be better served for that. So this is something that probably really needs, what it really needs is Congress to address it quickly so we know what we're doing. But right now, I would plan around potentially a tax event for the forgiveness amount. And the other that is kind of frightening people is, you have a small business that is struggling in the economy, and then we have this loan process that everyone's scared the money is going to run out, and we have to go apply for this loan, and then we go through the ordeal of all the things we have to do in due diligence to get the loan, and then we have to spend it on what we're supposed to spend it on and hope the economy recovers, because that's the ultimate thing. Well, in this process, to make it easy for everyone to be able to participate, businesses with 500 or fewer employees were eligible to participate in this program. There was one other carve out for businesses that are in the hospitality or restaurant industry. And so those were hit hardest and earliest. And so those are not covered by the same cap. Basically, if a restaurant or hospitality has less than 500 employees per location, then the company qualifies. And so there were some large companies that qualified for the loan, and we've all heard about these: Shake Shack, Ruth's Chris, they qualified for the loan. The LA Lakers qualified for the loan, and so they all borrowed this money. And so the questions began to arise in the press to the SBA and Treasury: is this really meant for small businesses that are waiting in line and the money's running out? And you've got these big, some of them publicly traded companies that cannot get, that got the loans and the others could not. And so they tried to address this in some of their commentary, and they have a Q&A section for questions and answers. So they created a question to try and answer this, and their question seems kind of be off base, but it says, do businesses owned by large companies with adequate resources of liquidity to support the business, do they qualify for the PPP loan? And so they actually added all of these answers that really didn't seem to answer that question. But basically, they reminded everyone that when they did borrow the money, they did have to assess their economic need at the time of the loan application, and remind them that before they submitted the application, that they had to assess the current economic uncertainty that makes this loan request necessary to support their ongoing operations. And further, the borrower had to make a certification in good faith that the current business activity, about their current business activity and their ability to access other sources of liquidity in a manner that would not be significantly detrimental to the business. And so, we all made those good faith certifications. Everybody did. And no one is saying that a company has to go bankrupt or just be destitute to qualify for this loan. But probably virtually all small businesses started doing triage in their head when this crisis arose. All right, what if this happens? What if this happens? What do I do? That, as they talk to their customers and their suppliers and the business community, they began to triangulate how this is affecting their company. It may not be today, it could be 2 months down the road, but they all formed a strategy and a plan, and they knew what the effects were. And so this is where we're encouraging everyone to go back and while this is fresh on your mind, document all those things. Just put a short memo together, put it in your file, because if the SBA does want to review the file and verify that it seems like it was a good faith certification, you've got all those thoughts down on paper. Because this particular SBA loan, unlike others, did not require borrowers to prove that they could not get a loan anywhere else. They just waived that because they wanted to get this money out as fast and quickly as possible. So the borrower is the one that provides this good faith certification. But at the end of this Q&A, it's kind of interesting that they said all that they're saying, and sounds like it starts with large companies, it reads to small companies, and then it says, for example, it's unlikely that a public company with substantial market value and access to capital markets will be able to make the required certification for this loan. So the SBA has already said that all loans under this PPP program over $2 million will be reviewed. They do have the right to review others. And the other thing to remember is that these loans are subject to the Freedom of Information Act. So the people that borrowed the money, which is virtually every small business, and the amount that they borrowed is probably going to be available for public inspection. And so we don't know who would request that or who would look at that, but it is out there. But don't, this is nothing to be ashamed of, because, none of us asked for this economic uncertainty. None of us asked for the COVID-19 crisis from a health standpoint or from our business and organizational standpoint. So, the federal government knew it, and that's why they brought this program about, so that it can help keep small businesses and keep people employed, because the best way to have employed workers 12 months from now is to keep them employed now. So with that, I will entertain any questions. I don't know if any of you have any, or if you've added any to the chat box. Okay. Well, hearing none, then I appreciate everyone's attendance. And if you have any questions, you can forward them to the Dawson County Chamber, and they will direct those to me, or you can reach out to me directly, and I will see if I can answer those for you, or find someone that can.